How to do asset allocation and portfolio rebalancing. That's the topic in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
What is the importance of the portfolio rebalancing and asset allocation?
Asset allocation is a very critical thing. Asset allocation is the first step, that you decide what part of your money should be in equity and what part of your money will be in fixed income. This is a crucial step, and there isn't a scientific formula. There isn't a very precise formula to drive it. To specify that people come up with some makeshift or some formula that deduct from 100 your age and that should be your equity allocation and something like that. Don't follow that. But basically, it's a very subjective thing. But having fixed equity gets you return, and equity gets you superior return, but it comes with great volatility. Fixed income provides you stability, and it comes with lower return with greater stability. So mixing your equity and debt provides, depending on how comfortable you are with the, what is your risk tolerance to the ups and downs of the market. If you are fine with it, if you are used to it, and then it can well be 90% equity, 10% debt, and you are comfortable with it, that's okay.
So your risk appetite
should govern that. But having it's all easier said than done. Investors' thinking is a very malleable thing. It changes with time. It changes with the market. It changes with the kind of return that you are getting. When the markets are going up, then people say that they have all the risk tolerance. They can tolerate they can withstand any kind of decline.
Yeah.
In a time like this, people are waiting to run away forever and depriving themselves of a great opportunity. So, and markets will remain cyclical. So, it's important for investors to decide on their comfort zone. And this is what we keep telling. When we say balanced fund, we are basically saying that 75% of your money will be in equity, remaining in fixed income.
Okay.
But you don't do the asset allocation yourself. We are providing a fixed income allocation inbuilt in the recommendation or at the advice, so that it does not turn out to be, it's a steadier take on growth. Likewise, but there are people who retire, they invest their money and they have no need for income from their investment. Still, they will be very uncomfortable if their investment is going up and down dramatically with the market. So, having a 50% allocation to equity, 50% allocation to debt, that does the job. After you have done this asset allocation, rebalancing comes into play. Because markets are cyclical. If you are assuming that you have decided to invest 50% of your money in equity, 50% in debt, which is your asset allocation, this 50% becomes 40% because market has gone down by 10% or 20%. If you would have done it a year ago and it has gone down to 40, and because your fixed income has gone up a little bit, so maybe your fixed income is now about 60% or 62%. And equity is down to 48 or 40 or 38%. That's the time when you should, on an annual basis, you should move your money to fixed income to equity. This effectively means that you are rebalancing it. You are, resetting the allocation once again at a defined periodicity, but not very frequently. Because if you do it very often, it will have tax consequence. It will have serious tax implication. You'll be quickly, moving back and forth on some asset or the other, selling some, buying something. It can all be done another way. If you are in your asset allocation, if you are in your accumulation phase, if you are, doing your investments even now on a regular basis, then to rebalance, investing your new money, incremental money in the asset which has gone down, that actually works that turns out to be more tax efficient. So you can actually reset the allocation with new investment being made into the asset which has fallen from your target asset allocation. So this is a nice way of buying low and selling high, or not selling something when it is at its low, but investing more in that, and in a methodical way. You follow it in a programmed manner, and this eliminates your emotional bias, because most of the time we do the opposite. When we are scared, then we don't invest, and that might be the good time to invest. And when we are, when easy market is going up nicely, quickly, so we just invest without thinking too much about it. So, and that is actually takes your allocation in a unusually risky zone.
Okay, so how do you rebalance your portfolio? Do you set an allocation range? What do you do?
I would say that investors should keep it very simple. If you have decided on a 50% allocation to equity and debt, do nothing if it changes by 10%.
Okay.
Because if it becomes 55 and 45, don't do anything. The moment it crosses that, take some action. Sell a part of the one which has gone up and move it to the other one, so that the combined value is split equally into both.
Okay.
I think 50% allocation actually gives you greater opportunity to rebalance it with simplicity. And I think over time this activity itself can enhance your return, because you end up buying low and selling high, even because in case of SIP you are averaging your investment, but in case of your accumulated investment, you see your investment crumbling and you do nothing about it, or you see your investment go up dramatically up and you do nothing about it, and then the market slips. So by doing the rebalancing, you will be able to lock in your profit. You will also be able to invest when markets are at its low.
For a regular investor, which most of us would be, do I need to take help from the manager? Do I need to take somebody's help, or should I do it on my own?
If you have been taking help, then you should be demanding this help, because if somebody is helping you invest and he is not providing you this advice or suggestion, then you should demand this help. It can also be embedded in your fund selection, because when you invest in an equity fund, then you are choosing to invest all your money into equity. When you invest in a balanced fund, you are choosing to invest 70% into equity, 30% into debt. You don't have to do the rebalancing yourself. The fund manager will do it, and he will do it in a more tax efficient manner. And your experience of investment will be the same in terms of greater stability than an all equity investment. Likewise, the equity income fund, which is a third of it in fixed equity, remaining at 2/3 in fixed income, that is a very conservative take on growth. So that is another thing where it has embedded asset allocation. The fund manager is supposed to keep that allocation intact. So you can do it with simplicity, you can demand this, or if you're doing it yourself, then make sure that you are doing it with fewer funds, so that implementing this strategy, implementing this plan, it can be done with 2 funds, 1 equity, 1 debt. It can be done with 2 equity, 2 debt. And that's all that it requires. And looking at the investment performance or investment's worth once in a year will do the job. Don't be hyperactive about it. If you try and do too much, over engineering, it'll hurt you.
Okay. For tax efficiency, shouldn't we be considering the hybrid funds?
Yes, hybrid funds turn out to be far more tax efficient, because whenever you take these actions, you are liable for the taxes for all the realized gains and all the realized losses. Okay. You get the credit for all the realized losses. When it happens underneath the fund, when you invest in a balanced fund and the fund manager is buying and selling something to retain the allocation at 70-30, or a equity income fund or a balanced fund at 50-50, you are not liable for any taxes. It is happening at the fund, so you are deriving the benefit without liable for the taxes. So this is a more tax efficient way of doing it. But many a times, investors would like to have a greater control. Also, the tax efficiency actually kicks in once your investments are 3-4 year old. Then doing yourself may not be very tax efficient. Earlier, the tax efficiency was far higher in these hybrids, because equity was not liable for any tax. It was completely exempt for tax, from taxes if held for over 1 year. There was no long-term capital gains. Now there is one. Likewise, in case of fixed income, after 3 years, it is treated as a capital. It's considered as a capital asset, indexed and gains. So once your portfolio becomes 3-4 year old, even doing it yourself may not have a serious tax implication.
Okay. So should one be more taking more risks, or should one be aggressive? Should one be conservative? So what is the appropriate asset allocation?
Depends. If you're a first timer, be conservative, because
Okay.
it's important to develop a belief. You know, it's like testing the water. Don't experience something in a manner that it scares you out forever. It drives you out forever. So then that's first aspect. Second is that, you know, if you have experienced the market for 2-3 years, you have understood its cyclicality, you have understood, and you have also experienced the gains, then you will be able to appreciate it better. Then I think, you know, but primary thing is, I think two things which matters most, and I don't think any expert can answer that, because that is very much your viewpoint, you know, which is very much unique to every investor. One is that how experienced you are. Depending on your, if somebody has been investing in the market for 5-7 years, he'll be more comfortable with the declines and the gains, or he will not get exuberant about what's going on. He'll not be scared, or he will not get as excited with the gains as a new investor will be. So one is experience. The other is how critical is that money. You know, if you in all you have been able to accumulate 8 lakh rupees, and that 8 lakh rupee, very important things depend on that. So depending on your needs, you will attach greater anxiety to that investment. If that, you know, and if you have accumulated 50 lakh rupees, and you know, you have some other assets, you have a nice cash flow, you have a great income, it is one of the thing, and you are still, you know, and the time frame that you have, you are unlikely to need the money for another 10-15 years. You will be in a completely different frame of mind. If you are likely to need this money in 3 years time, then you will have worry, and rightly so. So these are things which govern it. These are things, you know, so depending on the time frame, depending on how comfortable you are, and depending on the scale of money, I think most investors will do a good job by, you know, having a 50% to equity, 50% to debt, and active rebalancing. That will do well for them. If this is the critical money which you are likely to need after in a time frame of 5 to 10 years. If it is even longer, it is one of the secondary, you know, asset which you are accumulating. It is not the primary, you know, it's not all that you have. You still have 10, 15, 20 years. Maybe you can go up to 75% equity, 25% into debt, maybe through a balanced fund. If you are a venturesome person, and you know, you find that you want to realize great gains over the next 10 years, maybe 90% equity, 10% debt. So it entirely depends on these circumstances, which is very difficult to quantify, or an external expert to provide any opinion on. You are your own best judge.
Okay, so you heard how to do asset allocation and portfolio rebalancing, and once a year.
Annual, yes.
Annually, you need to do that. Okay.